Hi everybody, this is Alan Ellman, the Blue Collar Investor. In today's video we're going to discuss stock option expiration cycles. Many of you probably noticed that for each underlying security there are 4 possible option expiration dates. But you may have also noticed that they're not the same for each underlying security. You may have wondered why. In today's video we're going to discuss how these cycles were determined and the reasons why. Back in 1973, the CBOE decided that they would make options available 4 months at a time for each security. And each of the underlyings were assigned to one of 3 option cycles. The January cycle had options available in the first month of each quarter: January, April, July, and October. Securities assigned to the February cycle had options available in the middle month of each quarter: February, May, August, and November. And finally, securities assigned to the March cycle had options available in the last month of each quarter: March, June, September, and December. Now you'll notice that if you had an option in 1 month, you actually had to wait 3 months for the next option. Now that became a problem as the demand for shorter-term options increased. So in 1990, the CBOE decided to make a change. And the change they made is that options on each security would be available in the current or front month and the next month, and then 2 more opportunities depending on which cycle that security was assigned to. So for example, if January were the front month, and we're looking at stocks assigned to the January cycle, you would have options available in January, the front month, February, the next month, and then the first month of the next 2 quarters, that being April and July. Securities assigned to the February cycle, again, would have the front month January, the next month February, and then the second month of the next 2 quarters, that being May and August. And finally, securities assigned to the March cycle would have options available in the current month January and the next month February, and then the third month of the next 2 cycles, June and September. So let's take a look and see what would happen when the January options expire. Now you'll notice in all 3 cycles, cycle 1, 2, and 3, or January, February, March, you'll notice that all 3 have the same front month, February, and next month, March. In cycle 1, the next 2 option choices available are the first month and the next 2 quarters, that being April and July. Cycle 2 have the middle month of the next 2 quarters available, that being May and August. And finally, in cycle 3, they have the third month of the next 2 quarters available, that being June and September. And September is the month that was added from the previous chart. After the February contracts expire, October is added. So all 3 cycles have the current month March and the next month April. And cycle 1 adds the first month of the next 2 quarters, July and October. October being the one added from the last chart. Cycle 2 adds the mid-month of the next 2 quarters, that being May and August. And cycle 3 adds the third month of the next 2 quarters, that being June and September. And let's do one more. As the March contracts expire, that means April is the front month. So all 3 cycles have both April and May available. Cycle 1 adds the first month of the next 2 quarters, July and October. Cycle 2 adds the mid-month of the next 2 quarters, that being August and November. And cycle 3 adds the third month of the next 2 quarters, that being June and September. So if you wanted to find out which cycle a particular equity is assigned to, you really have to look at the third and or fourth months out to make that determination, because the first 2 months for each security is going to be the same. Now, just to make things slightly more complicated, some of the more heavily traded securities also have longer term options called leaps. and that can result in more than 4 available expiration dates. Now, conventional options can go as far out as 9 months, but LEAPS options can go out as far as 39 months from the date of its initial listing. All LEAPS options expire in January. Now, when LEAPS options are listed depends on the cycle that the underlying security has been assigned to, like we talked about before, the 3 cycles, January, February, and March. So, for example, Cycle 1 options are listed after May expiration. That's also going to be the date, as you'll see in a minute, when new options are listed. Cycle 2 are after the expiration of the June options, and that's when new options are listed for LEAPS for those securities. And finally, for Cycle 3 securities, new LEAPS options are listed after the July expiration. Now, let's say we bought a LEAPS option in 2010 and we bought the January 2012. Well, as we get closer to that January 2012 expiration, at some point in time, that longer term option is going to be converted or rolled over to a conventional option. When that takes place, once again, is determined by the particular cycle that underlying security has been assigned to. So, for example, for the January cycle, that LEAPS option is converted after the May expiration to a conventional option. We're talking about the upcoming January expiration. That's also the time, as you'll remember from the last slide, when new LEAPS options are listed a few years out. For securities assigned to the February cycle, these LEAPS options are converted to conventional options after the June expiration. So for the upcoming January LEAPS expiration, that's going to become a conventional option, and that's when new LEAPS options for that security are listed for a few years out. And finally, for securities assigned to the March cycle, those LEAPS options are converted to conventional options for the upcoming January expiration after the July expiration. And that's also when new LEAPS options for those securities are listed for a few years out. Now, this conversion has absolutely no impact on the contract terms of those original LEAPS options or the premiums. So let's do a quick summary. Most options are assigned to one of 3 cycles with 4 current expirations. All options available will be for the current month, the next month, and then the 3rd and 4th choices will depend on the cycle that security was assigned to. Some heavily traded securities also have LEAPS options or longer term expirations that can go out as far as 39 months, and these will result in more than 4 options choices. Now, just as an aside, as more and more and newer options products are created because of the demand, we also now have weekly and quarterly expirations, which are possibly a subject for a future video. So once again, I hope you found this video useful. As always, I could be reached at alan@thebluecollarinvestor.com, or visit my website at thebluecollarinvestor.com, where you can find an awful lot of great information on covered call writing and many of the associated subjects relating to covered call writing. Thanks for listening, everybody. Take care.